Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Okay, welcome to The Wealth Flow. My guest today is Neal Bawa. He is the CEO and founder of Grow Capitus and Mission 10,000, two commercial real estate investment companies. Neal's companies use cutting-edge real estate analytics technology to source and acquire or to build large commercial properties across the U.S. for over 1,000 investors. Currently, his portfolio is over 4,400 units with an assets under management of over $660 million. Neal shares his team's unique and cutting-edge real estate data methodology to connect with geeky and nerdy or just data-driven investors who share his vision. The data beats the gut feeling by a million miles. Neal also speaks at dozens of real estate conferences across the country and virtually online. He's very well known in this community. And Neal believes that we are at a turning point where traditional commercial real estate will be combined with prop tech and fintech technology disruptors and will truly reach its potential as a tradable, highly liquid asset class that will rival and eventually beat the stock market in both size and scope. Neal, I am looking forward to having you on again and hearing about all of this and everything that you've got going on. So welcome to The Wealth Flow.
Excited to be here. Excited to be back.
Yeah, for sure. And I like to go ahead and start though with, your background. Maybe for those that didn't hear the first episode, what eventually led you to this world of real estate investing?
Well, I'm a technologist. So computer science degree, data science is my background. And I was running a technology company for about 14 years from 1999 to 2013. And while I was running it, we were making a lot of money. And I live in California, so my taxes are incredibly high. And so in 2003, the senior partner in the firm, I was a junior partner, basically said he didn't want to rent anymore. He wanted to build a campus. So most people, Keith, they get into real estate with a single family rental or a fix and flip. And my first experience of real estate was a 27,000 square foot built from, scratch campus, right? So trial by fire. He just, sort of threw me in the deep end and we made lots of mistakes and no investors, it was just our own money. I don't even think we got a loan. We just used cash to build it and made lots of mistakes, but learned a lot. And at the end of that process, I had a tiny little slice of it. So the depreciation was remarkable. And before I knew it, we were building more campuses. And as we built more, I realized that I was making more and more money because of these campuses and the expansion of our business, but I was keeping more and more because of depreciation. And so it was just a light bulb went off and I'm like, oh my God, depreciation is incredible. This is just a phenomenal thing. And I need to do more of this. And as my bank balance went up and up, I finally got to the point where I was ready to deploy, and that happened to be 2009. Talk about timing. Right. So yeah, in that time frame, I was buying one single family rental every month for several years. And then basically for scale reasons, I knew that I had to move up. And so I started moving up to duplexes, then triplexes, then sevenplexes, then a 14plex, and then jumped all the way to 200 units.
Wow. Okay. Yeah, that's an incredible story just to get in with that. But man, to see the realization that you went through with the appreciation or depreciation rather, and just what that can do to the actual take home income.
It's dramatic. I mean,
Yeah.
it's an absolutely dramatic number. And yes, it takes a little bit of time for that to kick in, but it's absolutely dramatic what it's capable of doing. And once you become a general partner, you get even more depreciation, for the dollars that you're investing. So it's truly dramatic. And I didn't have any investors. I mean, I was by myself from 2008, 9, 10, 11, 12, 13, 14. It was just me buying for myself, buying for family. And so I took a very, very long time to jump into real estate as a professional. So my company was sold in 2013, and I think the first time I did a deal was the year after that. And so I was very, very slow to sort of react to this process, and I'm glad I did that because it gave me a lot of time to learn on my own dime. I made mistakes, I made horrible mistakes, and you sort of learned on your own dime versus other people's money.
Yeah, for sure. And so you're a technologist, how you framed it. When you sold your company, what type of business was that that you ended up selling?
It was a technology and healthcare school. And so we were very tech savvy and we were experts at internet marketing. And so we had class leading revenue, class leading profitability. I applied pretty much all of the things that I learned there for over 15 years into my real estate businesses to attract investors, to build systems and processes, to build benchmarks and reporting, to create, to use my data science background to create, useful formulas that could result in higher returns. And if you can look at our website and see our returns. I don't mention them on podcast, but it's been very gratifying. And the investor count built up. I started off in the first project with about 30 investors, and currently have 1,100.
Yeah. And so on that first deal that you brought in outside investors, tell us a little bit about what that was, and then kind of how it's grown from there, because I know you've had quite a bit of growth.
Sure. So I'll give you the one for my current company, Grow Capitus. So this is a property called Park Canyon, and it was 151 units, and it was in Dalton, Georgia, which is commutable to Chattanooga and also a long commute to North Atlanta. Um, and I went in. We bought this property. It was pretty much the best in the market, and so we were able to, for the first year and a half, keep our rents very high. And we were distributing about 8% to our investors. Then what happened was interesting, Keith. I visited the property just on my regular visits, and I realized that there was a empty parcel. This property was on a slope, so very lush green with a nice lake built in. I realized that there was an area that appeared to have been a building before. So I, on my visit, drove by the city, asked them about it, and true enough, there were 20 units there, and they'd burned down a while back. And the owner, instead of rebuilding them, they'd just taken the insurance money and let the units be there, right? So we called in a builder to check to see, if the foundation was good, and it was. There was nothing wrong with the foundation. They're just, bulldozed it over. Foundation was perfectly fine. So I went back to the city and I said, hey, you guys have been talking about, how painfully difficult it is to build in this area, and there's not enough new construction coming in, no builders are interested. What if I take this foundation and you give me a little bit of flexibility? Instead of 20 units, in rebuilding 20, I'll build 29 new units on it. And initially they hemmed and hawed, but eventually they gave me approval. And so we ended up, the catch, of course, was our bank wouldn't give us any more money, right? The bank's already loaned the money for the property, and they're not going to give us money. So I went back to my existing investors and sold them on giving me $100,000 each, $2.9 million total to build 29 units. That's $100,000 a unit. And so we built it in cash. We didn't take any loans for these 29 new units. It took about 16 months to build. And once those units had been built, the net operating income of the property spiked because the property's expenses were the same. Remember, the property taxes are the same. Those units were already there. They were already factored into the property taxes because they'd been burned, right? The property taxes don't reduce when units get burned. It's still the same property taxes. So those were there. We didn't have to increase the property taxes. I didn't have to build any parking because the parking for 20 units already existed within the property. I didn't have to do anything with the sewers. I didn't have to do basically anything on the outside, which meant that the $100,000 were directly just going into the units, right? And there was already sewage and everything else that had been brought to those 20 units before, and I just tapped into that. And as a result, almost all of the rent of those 29 units, which was roughly 30, 35,000 a month, which is about 420,000 a year, right? Out of that, about 300,000 ended up being net profit out of that 420. $300,000 in net profit per year at 5 cap is a $6 million increase in value. And I'd only spent 2.9 million, right? So on top of the value add benefits, the property was doing really well on its 151 units. We basically put in another $3.1 million of net profit and had a blockbuster exit.
Yeah, no, that is that's incredible. And you didn't see that initially in the due diligence just because it was over, there was growth or something that kind of prevented being able to see it, or the foundation wasn't just...
Yeah, there were trees in front of it, so it was not easy to see because it had been a while. I think that that area burned down at least 10 years ago, maybe 15 years ago.
Okay.
So it was hard to see in the due diligence. The property was on a slope, so it had a lot of trees anyway. So it took us a while before we figured out that this pad existed. And even if it's not unusual for there to be burned down pads in these kinds of buildings. Lots of people have done that. The coup was that we were able to figure out how to build it without an additional loan. We were able to take money from our existing investors, their cash, and build it. And that was hard to do, to convince people who had just given me money to basically give me $100,000 each more, right? So that I could build something. But we were able to do it, right? I mean, the key is to use data, and we used data. We showed them the math. We said, look, this is an absolute winner. I've been giving you 8% on this property for 2 years. It's rock solid. You know that its average occupancy is 98%. You know that the moment I build these units, they're going to be filled in 30 days. And they were. I mean, 30 days, we filled 30 units, right? We were doing some pre-leasing. People were waiting. We were signing leases. And so 30, 35 days, all the units were gone.
Wow, that's incredible. That is just that's amazing. So obviously, fantastic opportunity there. But that wasn't your only win. You've had several others. Tell us about some of the other ones along the way. And
Sure,
Neal, if you don't mind, because you do something a little, quite a bit different. Like you said, you really have taken everything that you've learned from the years and years before when it comes to technology, and really been able to apply that into what we do in the multifamily world. And so, if you can kind of explain how you utilize that as well, that would be fantastic.
Sure. So, as a data scientist, I am trying to understand what creates the most amount of wealth in real estate. And what creates the most amount of wealth in real estate is figuring out when to go to a certain city, when in its glide path to go to a certain city. That's what I'm known for. If you look on the internet and type in my name, I'm the only Neal Bawa on the World Wide Web, you'll see thousands of articles about what I talk about, what cities I talk about, or just try out YouTube. You'll see lots. Bottom line is this, right, Keith? There's over 1,000 cities in the United States. They're all on different glide paths. There is no real estate cycle. There are cycles, right? So, for example, Austin today is at the very bottom of that cycle. Rents are falling, home prices are falling. So, that particular city is not doing really well. But 3 or 4 years ago, that city was doing phenomenally well, right? Phenomenally. Right. Like there was no city in the US better than that, maybe Phoenix. Phoenix is also close to the bottom of its cycle, but not quite there yet. So knowing that and understanding that is very, very key, right? Also understanding what it is that makes rents go up. What is it that makes home prices go up? As it happens, there's about 30 factors that we use internally, but externally for people who want to learn this, we teach it to them. There's 13,000 students right now taking a real estate course that I present on udemy.com. So if you type in the words UDEMY and then my name, you'll see the course, and you'll see about 13,000 people taking it. These people, they're learning how to compare cities in the United States for real estate investment. Let's say I live in the San Francisco Bay Area. Well, the Bay Area has, a big city, San Francisco, but it also has 35 smaller cities. Well, which of these cities are better to invest in? They're not all the same, even though they're in the same, metro. And how do you compare those? So in 2009, 2010, I became obsessed with the idea of comparing cities. And so it took me about a year's worth of research, but I created something known as location magic. And you can find it by typing in location magic Neal Bawa. And the concept of location magic was, what are the top 5 things that affect real estate profits? What creates rent growth? What creates home price growth? And the answer is, it's as straightforward as a certain amount of job growth, a certain amount of population growth, a certain amount of income growth, crime at a certain level, and a home prices growing at a certain level. So it's not just important to have growth in these 5 factors, that's necessary, but you have to have a certain amount of growth, right? A certain speed of growth, right? Like population growth of 1% is not good, but 2% is, right? So I came up with these benchmarks and I applied them to 1,000 cities using a predictive analytics software called R. And I started to publish my data, and I started to publish it very early on. This is like before I was even using all of this data, because I was, I had this city that I'd found using predictive analytics, and I was buying there, and everybody there knew me. So I just kept buying in that city, which tends to happen. So I wasn't bouncing around myself yet from city to city, which has been one of my great regrets of my life. But I was in, I knew that city was 75% undervalued, and I just kept buying and buying and buying and buying more and more stuff there. And I mean, I'm not complaining. All of those properties now are worth 4x, 5x what I paid for them. So bottom line though is that other people started to use that data, and I started to publish it. First, I opened a meetup group. First time I did it, 4 people showed up. Next time it was 10. The third time I did it, over 100 people showed up. Because I live in Silicon Valley. Everybody is a geek, a nerd, and they were interested in this data-driven approach to comparing cities. And what I would do is I'd show them how to compare, right, which is what the course shows. And then I'd go through my top favorite 30 cities in 30 minutes in these meetups. Before I knew it, people were asking me to do it as a webinar. So I did that. Then 6 months later, I started getting phone calls from conference organizers all around the US saying, "You're that nerdy guy that teaches people how to compare cities for real estate." I said, "Yeah. Well, would you come and present at our conference?" And I said, "But I don't have anything to sell. So who's going to pay for my, my food and my airfare and hotel?" And they're like, "We'll pay for it." And I was like, "Really? And you'll give me a free ticket?" "Yes." Well, that sounded like a great deal to me. I mean, in hindsight, I should have charged for this. Now I do. But back then I didn't know better. So I was like, this is the greatest deal ever. I get a free ticket to this conference and free food and air and hotel. I'll go. So I'm this real estate guy running a technology company that basically takes a day off from his day job to go and teach at conferences around the US. So it's sort of just built up over time. And this community of very geeky, nerdy, data-driven investors sort of coalesced around me. The United States has, somewhere around 3 million accredited investors. Out of those 3 million, roughly 12,000 follow us.
Wow. Yeah, that's incredible. Well, but when you're able to show that kind of information, and it's, like you said, it beats a gut feeling. You have actual analytics that you can look at and say, hey, this is an area that we should take a look at. And so with that in mind, what are some of the areas that maybe would be unexpected that you say, you know what, right now, this is a spot to watch?
I think right now, actually, this is a curveball for sure, but I'll mention it anyway. So when interest rates go up, prices of multifamily go down, because multifamily is a business. Single family is not a business, right? It's an emotional purchase. People want to live in that home. So we've seen home prices in the United States decline by just a few percent. Mm-hmm. They haven't gone up. They haven't gone down. Over the last 24 to 30 months, home prices in the US are fairly flat. Maybe they've gone up a couple percent. But multifamilies dropped by 25 to 30%. That's because it's a business. If your expenses go up, you will pay less for a business. Expenses go up when your mortgage goes up, right? Mortgages have gone up because of interest rates. So multifamily by itself is actually a very, very discounted product at this point of time. It won't stay that way because eventually over the next year and a half, interest rates are going to come down. So it's actually a terrific product to buy, but there's bad buzz around it, which I really like. I don't want that bad buzz to go away. I want more and more people on television, Fox News and CNN say bad things about multifamily, because when they start saying good things about multifamily, I have a lot more people competing against me. So competition is there, but it's down compared to 2022 when we weren't even getting into best and finals, let alone, buying properties. just didn't have, the ability to buy them because people were willing to overpay. So the market's more stable. I don't see a lot of people overpaying. I see people being a little more cautious. Instead of saying we're going to have 4% rent growth, people are now projecting 2.5% rent growth. That, so it's more conservative. Instead of saying I'm going to exit at a 4 cap, now people are saying I'm going to exit at 5.5 cap. So there's conservatism that has come into the marketplace, and that's always a good thing because the market was too bubbly back in 2021, 2022, and now we're seeing better numbers. So I like multifamily. But ironically, the best market when interest rates are high is not multifamily. I love multifamily and I'm still buying them. I'm telling you, it's my bread and butter. So I haven't changed my mind on that. The best market when interest rates are sky high like today is land. It's land. The reason for that is developers get hit harder when interest rates go up than value add properties. So development activity slows. For example, in one city that I have invested in, San Antonio, multifamily permits are down 78% from peak. So for example, if there were 10,000 multifamily permits in early 2022, today there's only 2,200, 78%. In that time frame, San Antonio has continued to grow. It's a very fast growing city. So when that happens, the demand for land drops. And when the demand for land drops, the price of land, unlike the multifamily prices have gone down by about 25%, roughly. Land prices don't go down by 25. They go down by 50 to 60%. So we are making offer, and here's the cool thing, right? We're not buying land. You know what we're doing? We're putting land in contract on very long, leashes. So we have 12 pieces, maybe 14 pieces of land in contract in the United States right now. All of them have 21-month timeframes, 21 months each. And out of those 14, we'll probably build 4 and we'll flip the rest, right? By just changing the zoning and drawing a nice little $5,000 site plan and basically doing a very nice marketing, set up some nice renders, and we'll flip it to developers, usually less experienced developers than us, that will buy these. And, on average, probably, clear $1 million in profit on those 10 or 11 that we don't build on. We'll just take the best ones that we like the most, where everything's going right and the cities are, quick and the builders are coming in with good quotes, and we keep those. And then we'll flip the rest. So I expect that over the next 2 years, we'll probably end up clearing about 10 million on those pieces of land. And anyone can do it. We probably may not do those numbers, but I think that the mathematics works if you go for smaller pieces of land as well.
Yeah. No, that's great insight. Yeah, for sure. Makes total sense too. And I love San Antonio. That's where I'm at now. And it has incredible growth. It just continues to be pretty much everywhere from here to Austin. So it's great. So that's one avenue for sure. And you did mention what are some other areas of the U.S. that you feel maybe from a multifamily standpoint are kind of in that glide path that you speak of?
Yeah. So the areas that are in the glide path right now, none of them are in the southeast of the United States. So the southeast was the hottest part of the United States for multifamily for at least 6 or 7 years. I'm talking about, Dallas and Austin and Houston. I'm talking about Nashville. I'm talking about, all the Floridian markets like Orlando and Tampa. None of those markets currently are what we call in that glide path. It doesn't make any sense. These markets have so much inventory that it's going to take them a while to recover, right? So for example, Raleigh is probably one of the best markets in the United States. If I was paying all cash, was a billionaire, and wanted to look at a 10-year investment, I'd probably go for Raleigh. Maybe Dallas in second position, Phoenix in third. But I wouldn't go to Raleigh right now to buy a property because of where it is in its glide path right now with huge amounts of new supply. So almost all of the big supply in the United States was either California or the Sun Belt states, southeast. So right now, everything in the glide path are places that have high rent growth, high population growth, but very little incoming supply. They didn't boom from a supply perspective like Phoenix did or Austin did or San Antonio did. So Burlington, Vermont is an absolutely phenomenal market. I think that people, you might think about Burlington, Vermont. That's a really small market. My question is, why is Blackstone investing there? Blackstone invests in superstar markets. Blackstone invests in gateway markets. Why is Blackstone investing in Burlington, Vermont? That's a question to ask ChatGPT, and you'll get some interesting answers. Another market that is absolutely phenomenal is Northwest Arkansas. Northwest Arkansas is a 500,000 person area with 4 cities, with Rogers and Bentonville being the biggest cities. The third one's called Fayetteville. This area has absolutely astonishing growth potential. And I don't think of Arkansas as a fast-growing state. Right? I don't think of it that way.
Exactly, yeah.
But the mathematics of this area are absolutely phenomenal. So I've traveled to some of these areas, and once you get there, you realize what's going on. The Waltons have become more, philanthropic over time, right? So that, as a family, they're the richest family in America. If you combine all of them together, they all live in Northwest Arkansas. They live in either Rogers or Bentonville. And they've basically pumped billions of dollars into improving this area, building, hundreds of miles of bike paths and things like that. The area is very scenic, so the bike paths work really well because it's scenic. So it's an extremely beautiful area. And then Walmart has basically created a mandate where they're saying, if you're in middle management or upper management for Walmart, we'll give you a year and you have to move here. Otherwise, resign. Right? And that's for 18,000 middle managers and upper managers. And people don't want to leave Walmart, so they're moving there. So, there's a lot of things going on there. That's right. Burlington, Vermont is becoming almost like a VC kind of, place to have a second home for all these Boston venture capitalists, right? It's not too far. So there's reasons why these markets do well. And usually my data doesn't tell me those reasons, Keith. The data points to something is happening here. And then you have to go figure out what is that thing that is happening there, right? So that still requires boots on the ground, but the data points you in the right place. So those are great markets. Charleston, South Carolina is today a phenomenal market to invest in. It has the highest rent growth in the United States. There's not enough construction. It's very hard to build there. So it's hard for new construction to come in. So terrific market. Charleston, South Carolina would be another market that I would look at. So there's a lot of markets like that around the United States. Idaho Falls is a market that is hugely benefiting from the return of nuclear. As you know, Trump is very pro-nuclear. Bill Gates has put billions of dollars of his personal money into nuclear. And all 4 of the big, or all 5 of the big tech companies are now buying nuclear plants. So Amazon recently invested in a very large nuclear plant. Microsoft invested in 3 Mile Island. These are billion-dollar deals. Why are they doing it? Because they need to triple their electricity usage over the next 5 years because of artificial intelligence. So any place that is deeply tied to nuclear will have a very powerful growth. As it happens, Idaho Falls has by far the largest nuclear lab in the country. The Idaho National Labs, or INL, has long been the flagship of nuclear in this country. So when Bill Gates is investing in startups, all of those new nuclear reactors are tested in Idaho Falls. That's the only place where you can test them. The government doesn't allow you to test them anywhere else. So INL is growing by leaps and bounds. Especially in the last 30 days, the news on the nuclear side has been extraordinarily explosive. But we knew this. I started investing in Idaho Falls in 2020. My first project was a huge success. My second project is almost built. So I'll be starting lease up in about 10 weeks, 11 weeks. And so you have to be ahead of the curve, and you don't necessarily need to be as far ahead of the curve as I was in 2020. Being 1 year ahead of the curve is still sufficient information. Like Burlington, Vermont, right now is a great time to buy. Absolutely a terrific time to buy in Burlington, Vermont.
And so, and tell us, if you could, a little bit about what types of investments you're building there. I think last time, as we spoke before the show, you had talked a little bit about building some build-to-suit townhome type stuff. But in like, for instance, some of these where you are investing ahead of time, what type of projects are you investing in?
Depends on the market, depends on vacancy, depends on incoming supply, depends on rents. So I do all three things that typically real estate folks do. I build apartments, I build townhomes, and I buy apartments, right? There's not a lot of townhomes to buy. The inventory is pretty low, but I could say I buy apartments and townhomes, and that's fair as well, right? But really, those are your three options. Now, traditionally, until the last 6 or 7 years, most people built apartments. They didn't build townhomes because the most people that wanted to live in homes would go out and buy a single family starter home. But since 2020, since COVID, in only 4.5 years, we've now gone to the average mortgage in the United States has gone up by 111% in 4.5 years, 111%. Some of that is home prices up 44%. Some of that is interest rates. Combination of the two, 111%. But incomes in the United States have only increased by 19.6%. 19.6% on incomes, 111% on your mortgage. And as a result, in only 4.5 years, we have marooned 18 million American middle-class families to the forever renter status. The damage before COVID was bad. The damage after COVID has been colossal. So an entire group of people that before COVID would have somehow managed to find their way to a starter, home and buy it, even if it was in the boonies. Now their chances are zero. I'm talking about people that earn between 65K and 85K in smaller cities, and you can bump those numbers up by about 15K in larger cities, right? They don't have a chance. They're now $40,000 in income behind what it takes to buy that crappy boonies starter home. They are forever renters. Unless the market turns around and home prices crash by 20%, not going to happen. They're forever renters. Nobody is catering to this audience of people that does not want to live in apartments and cannot buy single family homes. My company does. So one of my companies only builds rental townhomes, right? So you've got the backyard, you've got the garage, you've got nobody above and below you. Sure, you've got two walls that are shared, but as you know, 99% of the noise comes from people running above you, not running to the sides of you, right? So people don't mind the fact that there's somebody living to the sides of them as long as there's nobody living above you. And, you go live in an apartment complex, even a brand new one. I mean, you have hallways that are 200 feet long with people running up and down the corridors, the smell of marijuana. You've got, dogs, Rottweilers, in there. People don't like that, right? So this missing America or middle America there's a missing solution. And I believe very, very strongly that the solution is the rental townhome. And this is not a fancy 2,000 square foot 4-bedroom townhome. This is a straightforward 3-bedroom, 1,300 square foot townhome, right? Still 9-foot ceilings, granite countertops. It looks nice. 1 car garage, not 2, because the math doesn't work for 2. I have to stay within their income levels. And then the second car is parked on the driveway or, just surface parking in the community. I don't build very fancy clubhouses. I don't have pools in my community because the missing middle, the people that are attracted to townhomes, they want a home. They're not interested in fancy clubhouses and infinity pools. There's lots of apartment complexes that offer that were built in the last 3 years, and they can go live there, right? But the people that are looking for a home, especially the ones with children, are the ones that are like, yeah, it's a nice townhome. I want to live here, and the rent has to be below 2,000. So the vast majority of my build to rent product, the average rent for 3 bedrooms is below 2,000 a month, right? So people with $70,000 in income are qualifying.
Yeah, that's great.
And they're living in a brand new property built in 2024.
And so from a geographic standpoint, where are you building these right now? Or where have you over the last, say, 3 years?
So my formula is actually very powerful, but staggeringly simple. I love Texas. I love Florida. These are very high growth markets. I'm not building there. Why? Property taxes and insurance and land cost. Property taxes, insurance, land cost. So a while back, we looked at every single market in the United States and we asked ourselves this straightforward question. Where in the United States can we find a combination of all of these factors? All is the key word, right? Low property taxes, low insurance, low land cost, high population growth, high rents. All of them have to happen. Not 4 out of 5, but 5 out of 5. Of 1,016 markets, only 18 markets match those criteria. There's lots of markets that match 4 out of 5 criteria, and usually the criteria that they don't match is either low property taxes, or they don't match the criteria of high rent growth, right?
Yeah.
But we needed all 5, and that's extremely difficult to find in the United States. So, the markets I've already mentioned, Burlington, Vermont, Rogers, Arkansas, and Idaho Falls obviously match it. But there's bigger markets that match it. For example, Kansas City. When you look at Kansas City, the first question I get is, wait a minute, isn't Kansas City low rent growth? Yes, but not in the next 4 years. Because in the last cycle, nobody built in Kansas City. And because there hasn't been much construction, if you log into CoStar, which is a tool that the industry pays for, most people in the industry pay for it, $25,000 a year or thereabouts. If you log into CoStar and you pull a very powerful Southeast city like Raleigh, superstar city, right? Raleigh. And you look at the curve for forecasted rent growth in Raleigh, it's about 2.5% for the next 4 years. Now go and look at for Kansas City. I won't tell you what it is, but you're going to fall down. It's going to be a shock to you as to what it is. And the difference between the two markets, Raleigh is a better market. Raleigh has more jobs and better jobs. But Raleigh also has 10 times the incoming supply that Kansas City has, right? So often the cities don't make sense. Often you're like, Kansas City? Really? Kansas City? Yeah, but because Kansas City does have growth. It has Overland Park, which is a job magnet, right? And it has a lot of good things going for it. And now that Trump has won, and if he imposes tariffs, then the top 10 cities in the United States that have manufacturing are all going to go crazy, because for the first time in 50 years, manufacturing in the United States will be cheaper than China, right? Because they have a 60% tariff, right? So all of a sudden, anywhere in the United States is cheaper to manufacture than China. I'm not going to talk about what that'll do to inflation. It's bad news. But on the other hand, if you're manufacturing, where would you go? Well, you'd go to like the cities that already have all the manufacturing capabilities. Well, what's that? Indianapolis, Kansas City, Oklahoma, right? All these, Tulsa, these cities already have all of the infrastructure. They already have all the zonings. They already have all the industrial buildings built, because you don't want to go and build industrial building. You just want to take over one and immediately put your machines in and start manufacturing product in 6 months. Well, that means that you already need massive amounts of industrial input. So all of these cities that have this input, Grand Rapids, Michigan, they're going to do phenomenally well, right? So the key is the day Trump actually imposes tariffs, I'm not convinced he will. If he imposes tariffs, he changes U.S. manufacturing. Everyone that's been saying manufacturing is coming back to the United States so far has been wrong. Here's the right thing. I'm data-driven, so I want to be very specific. There's been an increase in manufacturing growth in the United States. But that increase, if you multiply it by 100x, then we can say manufacturing is coming back to the United States. So there's an increase. We see it. It's a nice little spike. But if you want to bring 20 or 30 million jobs back to the United States, you need to at least 20x, 30x the current number, right? We've done nothing. No president. Every president talks about it. Bush talked about it. Obama talked about it. And Trump did too. And so did Biden. But they've never done anything disruptive enough to bring that many jobs back. But a 60% tariff on China immediately creates an astonishing industrial boom, along with astonishing inflation, unfortunately. And the moment you do that, the Rust Belt becomes the big game in town. So one day after tariffs are imposed, me and my checkbook will be out there.
Yeah. Interesting. Yeah, it's always an incredible perspective. What are some other things that are out there right now, Neal, in this environment that we're in? Obviously, a lot of change going on, but what are some other things that are just out there that you're keeping an eye on, you and your team are keeping an eye on when it comes to investing?
I'm worried about inflation. I am really worried about inflation because every single thing that Trump wants to do is inflationary. And last time he said some things and he didn't do them because he didn't have control of Congress in his first term. Well, he now has both houses of Congress. He has a clear mandate. Also, Trump is a lot less afraid of the establishment, right? This time he just wants to do what he wants to do. He's like, I won, you guys have to listen to me, rather than the other time around where, the Republicans were telling him who to put in. So he's just going to do what he's going to do. Everything that he's doing is inflationary, right? And again, I am not a Republican or a Democrat. I'm an independent. I'm not at all fond of the Democrats, but I definitely, from a monetary perspective, I can see what a policy is going to do, whether it's going to be inflationary or deflationary. Well, all of his policies are inflationary. So firstly, holding on to existing real estate in an inflationary environment is generally a good thing. Hopefully you have a fixed loan. But the second thing that you should be aware of is that we need to be very careful about whether Trump's Cold War with China turns into a hot war. So the biggest X factor in commercial and residential real estate for the next 5 years is, will Trump actually lead, sort of he's going to get very aggressive with China, lots of bad words will fly. And if the Chinese decide to invade Taiwan, it's likely that we'll get pulled into a hot war with them. A hot war is a very, very problematic scenario for the United States, extremely problematic. And, if that happens, I will divest a lot of my real estate assets immediately.
Yeah. Well, I was hoping to end on a good note, Neal. I'm kidding.
Well, I'll give you a good one here, though, right?
Okay.
Even if we get into a hot war with them, if he imposes tariffs, you should look at industrial. I know, Keith, a lot of your guys are multifamily people.
Right.
But we're buying real estate. Industrial is actually easier to buy. What is industrial? It's 4 walls with the right zoning and loading docks, right? Don't you think it's actually easier to manage industrial? 200,000, square foot industrial project only has 5 tenants.
Yeah.
Not 200.
That's
right?
true. Yeah.
Look at industrial. If he imposes tariffs, I can tell you that cap rates for industrial in the United States will fall by at least 100, 150 basis points. You don't have to build anything. Just buy.
Yeah.
Buy.
Okay. Oh, no, that's good. That's good. I think that puts us in a good spot. So, Neal, I know I want to be respectful of your time. I know we've got kind of a tight call today. If you could tell everybody where they can find out more about you, if they want to invest with you, if they want to enroll in some of your courses, where can they find you?
Sure. We have a large community. So about 80,000 investors follow us. We provide a massive amount of data-driven education, just a massive amount. So there are 3 different ways of finding us. Number 1 is my name. I'm the only Neal Bawa on the World Wide Web, followed by whatever social media you're interested in, whether it's LinkedIn, TikTok, Instagram, right? So just my name on your social feed is a good place to start. The second place, which I prefer, is Multifamily University. So go to Google, type in Multifamily University, click on the link, and you'll go to a website called multifamilyu.com. And you'll notice that we do 12 webinars a month, a year there. The webinar we did last week had 2,600 registrations. It was called The Impact of Trump on Real Estate. It's currently the most replayed webinar on our website, so you can imagine why. So we've had about 1,000 replays in the last week alone on that. So, but each month there's a new webinar. So the last one was Airbnb, the sort of our study of the Airbnb market. And the next one is our study on the industrial market, and that will be in December. And join that community. What'll happen is, that community is free. We don't offer paid education. We have no intention of offering paid education. What happens is that when you join that community, when we do the webinars, we take 60 seconds in the webinar to tell you what we are doing in terms of buying properties or building properties. And that's our advertisement, if you want to call it, in the middle of a webinar for 60 seconds. And so if that catches your fancy, invest. Otherwise, just keep coming. Of the 82,000 people in our ecosystem, 1,000 are investors. 81,000 receive free information. So we have a Wikipedia-style model, and it works really well because the 1,000 is all we needed.
Right. Yeah, no, that's great.
Right. So that's a way of doing it. And if you like our courses, type in the word Udemy, U-D-E-M-Y, Udemy, and then my name, and you'll see our most popular course. So there's about 13,500 students taking it.
Fantastic. I've got 2 other questions for you if you have just 1 or 2 more minutes. What advice would you give somebody who's maybe just starting out in their investment journey?
Well, I'd like to share something with you. right? The Bible, it got it wrong by a single letter. It is not the meek that shall inherit the earth, Keith. It's not the meek. It's the geek.
Yeah,
It's the geek. Richest man in the world, geek. Second richest, geek. Third richest, geek. Do you see a pattern, Keith?
Yeah.
You see a pattern there, right?
For sure.
So I think that all of us need to become more geeky. And it has never, ever been easier. I have several dozen conversations a day with ChatGPT and Perplexity. I use two tools, both paid, ChatGPT and Perplexity. I have several dozen conversations with them every day, right? You probably won't start at a few dozen, but never let a day go by where you haven't asked a few questions of these incredible tools. You have the oracles of knowledge in your pocket for free. Use it. Use them.
No, that's great. That's fantastic. One last question for you. It doesn't have to be real estate related, but it certainly can be. Just a book recommendation.
So I like The Miracle Morning. And the reason for that is I never tell people that Miracle Morning is the best book ever. It's not. But Miracle Morning may be the book that leads you to finding your best book. Because if you follow The Miracle Morning, you will be reading for 20 minutes a day. And that 20 minutes a day will lead you to your favorite book, the one that will change your life. So The Miracle Morning is a great accelerator of your success.
Yeah, it's a great book. All right, Neal. Well, this has been great. I knew it would be. And I thank you so much for being on the Wealth Flow. And I think we'll call it a show.
Sounds good. Thanks for having me again.
Yeah, thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.